Hello students, we are starting the second lecture of strategic financial management. So in last lecture what we have done is we have understood time value of money, and we have understood that 8 type of ways in which we can find out a future value as well as present value. Also we did something about valuation in finance, and what was valuation in finance was a present value of future cash flows. So what we'll be learning today is we will be learning some portion of time value of money that we have not done yesterday. Also, we will be commencing with the sums of security analysis, and we'll be also learning some of the basics of security analysis. So let us first jump into again time value of money concept. And we are learning, try to understand, if my principal is 1000, rate of interest is 12%. What will be amount after 2 years? Now this question we have covered in last session. But understand, if your bank says that we calculate interest every 6 months. Now understand, in yesterday's lecture we were assuming that interest is calculated every year. So we wrote our formula A is equal to P into 1 plus I raised to N. And what was N? We were treating it as number of years, but actually N is number of times interest is calculated. Is it all right? So we'll be keeping it as a year, but understand now if you are investing for 2 years and interest is calculated every 6 months, so basically you are getting 12% for 2 years. But now no, you will be getting 6% for 4 times. Is it alright? Because in 2 years there are 4 6 months, and as it is 6 monthly, instead of 12% you will be getting 6%. Is it alright? So this formula can be easily converted, but try to understand. First I am introducing you with a concept of K. Now say in some books it might be written T, in some books it might be written some other variable, but we are writing it as a K. Now what is K? Number of times interest is calculated per year. So in 1 year, how many times interest will be calculated? If interest is calculated every 6 months, my K will be is equal to 2, because now in 1 year 2 times interest will be calculated. If it is daily, my K will be 365 or 366. Is it alright? If interest is calculated monthly, K will be nothing but 12. Is it alright? All of you agree with this, right? If it is quarterly, quarterly is every 3 months. So K will be is equal to 4. Every 3 months means in 1 year 4 times interest will be calculated. And it is, if it is every 4 months, K will be 3. Is it all? If it is continuously, we are going to today understand when the interest is calculated continuously, this full formula will change. Is it all? But now try to understand logically what changes I am making in this formula. Divided by K. Is it alright? Let me rewrite this. 12% I was getting 2 times, but now I will be getting 6% 4 times. Is it alright? So 12% should be converted into 6%. So I'll have to do divide by 2. And this 2, this was number of years, so it was 2. Now it should be converted into 4 times. So here it will be multiplied by K. And believe me, now I will be getting the answer. What will be my answer? What is P? 1000 into 1 plus I is 0.12, but divided by 2. Now understand, it is automatically converted into 6%. If you will say this, it is automatically converted into 6%. Is it alright? So raised to what is n? 2 years. But now I am getting interest 4 times. It will be automatically converted into 4 times, and my answer will be 1000 into 1.06 raised to 4. That will be 1.06 multiplied by is equal to this is raised to 4 multiplied by 1000 is nothing but 1262. Start. Ultimately, 6% is compounded 4 times instead of 12% 2 years. But this is a formula by which I can incorporate this concept of K. If interest is not calculated yearly, you will always have to use this. Now, sir, can I do this question logically? The answer is yes. Amount is equal to principal 1.06, because I know that interest is going to be calculated at 6%. How many times in a year? 2 times in a year. How many years? 2 years. So it will be raised to 4, and ultimately it is the same thing over here. Is it alright? So when the interest is not calculated yearly, you will have to introduce the concept of K and this one new formula, that is concept of K. Next point that we are going to learn is real versus nominal interest rate. Alright. Here I will be asking someone question, so be ready with your mic. Try to understand, I am having 2 banks and I am having say 100 crore rupees in my pocket. I am either going to invest in SBI Bank or going to invest in UBI Bank as a fixed deposit. What is the rate of interest SBI Bank gives me is 10%. I have not explained you, but understand that this is nothing but a nominal rate. And by nominal rate, you should never take your decisions, because UBI Bank is also giving you 10% rate of interest, and this is also nothing but a nominal rate of interest. As I told you, you should never take a decision based upon nominal rate of interest. How many crore you are having? 100 crore, and you are having option. You could invest in SBI Bank, you could invest in UBI Bank. See what is the difference? Here K is 2. What does it mean when I say K is 2? Interest is calculated 2 times in a year. That is, interest is calculated every 6 months. And in UBI Bank, K is 1. So it is yearly. Interest is calculated yearly. Is it alright? Let us start with Mehak. In which bank, Mehak, you will invest and why?
SBI Bank.
Alright, Priyanshi is given. Yes, Mehak.
Yes, sir, SBI Bank, because I will be getting interest 2 times, and after 6 months it will be compounded, so that I will be getting interest on interest.
Interest 2 times is your idea, or interest on interest is your idea? Because if you are getting interest 2 times, understand you are getting 5% 2 times. Huh?
Yes, I will be getting 5%, but again I will be getting interest on that 5% also, which I will not be getting in the UBI Bank.
Okay, so you say that the investment should be done in SBI Bank. Is it alright?
Yes.
Alright. Now understand, SBI Bank will always be beneficial, but by just seeing this rate, 10% rate, you cannot make a decision. But what we are going to find out is a real rate of interest, and believe me, by just comparing real rate of interest, your answer will be absolutely correct, which is right now also correct, which is SBI Bank. Suppose if I invest this 100 crore rupees in SBI Bank, after 6 months, I will be getting 5% interest. What is 5% interest on 100 crore is 5 crore? What will be amount after 6 months? This is amount after 6 months is 105 crore. Now in the next 6 months, that is 6 to 12, this is also 6 months, I will be getting again 5% interest, which will be nothing but 5.25. What will be amount after 12 months? Amount after 12 months is nothing but amount after 1 year. It is 110.25 crore. Is it alright? If I invest the same 100 crore rupees in UBI bank, 1 year interest I will be directly getting, because interest is compounded yearly, it will be 10 crore. And total will be 110 crore rupees. This is amount after 12 months or 1 year. Always greater is better, because we are investing. Here I am getting interest of only 10.25 crore. Here I am getting interest of 10 crore. So which is better? Here I am getting interest on 10.25 crore. Here I am getting interest of 10 crore. Which is better? If my investment amount is same, 10.25 crore is better. So my answer is correct, that you should invest in SBI bank. Now try to understand my question. What really you are earning from SBI? 10.25 crore on investment of how much rupees? 100 crore. Then how much actual rate of return, how much real rate of return you are earning is 10.25%, and this 10.25% is nothing but real rate of interest. Whenever you go to a bank will always quote which rate of interest? Nominal rate of interest. Alright. And in this, how much you are earning as an interest? 10 crore divided by what is investment is 100 crore multiplied by 100, that will be nothing but 10%. And believe me, your real rate of interest and nominal rate of interest will remain same, because it changes only if the K is not 1. Is it alright? So your K is 1, so real interest rate and nominal interest rate will be same. But whenever K is not equal to 1, your real interest rate and nominal interest rate will be changing. Is it alright? This is my real rate of interest, and believe me, by comparing real rate of interest, say compare this figure, this figure. Now where you will invest? You will always invest in SBI bank. Is it alright? So this is nothing but investment in SBI bank is beneficial, because the real rate of interest is more. Is it all? Now go to practical life. You go to SBI, you might have heard n numbers of people saying that in SBI the rate of interest was 7%, in this and this bank the rate of interest was 7.2%, so I invested in a bank which was giving me 7.2%. They might not be taking every time sound decision, because they are comparing which rate of interest? Nominal rate of interest. Which rate of interest you should actually compare is real rate of interest. Is it alright? So real rate of interest is important. To find out real rate of interest, sir, every time we need to draw this chart and find out real rate of interest by comparing this? The answer is no. You can directly find out real rate of interest by doing this. 1 plus I upon K raised to K. See, believe me, what is this? It is amount of rupee 1 invested at I rate of interest with K, K might be 2, 6, anything, for 1 year, because what is multiplied over here is N into K, that is nothing but 1 year. Is correct? It is amount of rupee 1. So I am removing rupee 1. I will be getting interest. I will be getting answer of interest, because this is amount. Say this portion is amount. And this is principal, that is nothing but 1 rupee. Is it alright? Then amount minus principal will be nothing but interest, and I will be getting interest rate. Let me verify whether in this case my answer is correct or not. Is it alright? What is the rate of interest? 10%. So it is 1 plus 0.10 divided by interest was compounded 2 times raised to 2 minus 1. This will be 1.05 raised to 2 minus 1. If I open my calculator, 1.05 raised to 2 minus 1. What is the answer? 0.1025. Multiplied by 100. It will be giving me answer in unit. If I want to find out in percentage, it will be multiplied by 100, which is nothing but 10.25%. So my answer is also absolutely correct. So this is one more formula in our formula book, which is finding out a real rate of interest from any of the question. Is it alright? So after completing this, please try to understand one more concept which you have not learned in your foundation level, even at your intermediate level. When interest is calculated is also sometimes spoken as compounded. When interest is calculated monthly, we have taken K as 12, 6 monthly K as 2. But when interest is calculated continuously, start it. Then amount will be is equal. See, what is the meaning of continuously? Even the calculation is not done after a point of 1 day. It is done continuously. Every millisecond, every microsecond, the interest is calculated and you get compound interest on it. It is P into E raised to RT, and where E is a universal constant. So by this you can find out future value. Of course, if you want to find out present value, it will be P into A multiplied by 1 upon E raised to RT, and you will be getting present value. But this is applicable only if interest is calculated on continuous basis. Is it alright? So this is sir, where is the logic of this formula? Believe me, this is too technical, because it is having a concept of E. Also, you try to understand what is happening. Interest is calculated every microsecond, and that interest will be compounded. Is it alright? So this type of formula, where the interest is calculated continuously. As far as this chapter is concerned, this is time value of money, not a separate chapter in your finance SFM. But still it is utmost important, because it gives you the base of valuation. What is valuation of anything in finance? Is present value of future cash flows. Present value. So finding out present value becomes extremely important. Sorry. Let us recapitulate all the formulas that we have done up till now, because that will be helpful in preparing a formula bank. Formulas for time value of money. We started with A is equal to P into 1 plus I raised to N. Whenever I want to find out future value. But when I want to find out present value, it was A into 1 divided by 1 plus I raised to N. This 2 can be treated as the same formula, I don't mind. Next is when the interest is, when you need to find out a present value of infinite cash flow without growth, then it is value of first year. I am writing cash flow because normally in finance it will be cash flow. Is it alright? It is cash flow of 1 year divided by, and let me write down value of 1 year. Value of 1 year divided by rate of interest. Is it alright? When you want to find out the present value of infinite cash flow with growth, what is the formula? Value of first year divided by rate of interest minus G. This all formula we have done yesterday. Is it alright? But I am just recapitulating all the formulas that we have done. Is it alright? When the K is involved, A is equal to P into 1 plus I upon K raised to N multiplied by K. Is it alright? Same way, if I want to find out present value, I can just reverse the side. Also, when the interest is compounded continuously, E raised to RT. Is it alright? When this is used only when interest is calculated continuously. Alright, so these are the formulas which are important when you are doing time value of money. Of course, we have forgotten the formula that we have done today. If you want to find out real rate of interest, I can find out by 1 plus I upon k raised to k minus 1. I will be getting answer of a real rate of interest. So these are the formulas that we have done in the chapter of time value of money. You should be very much comfortable using this all formulas. Is it alright? So hereby we are ending the basic concept, which is basic concept of strategic financial management, which is nothing but time value of money. So we will be now continuing with our basic that we have done yesterday, that is nothing but valuation of securities, but we will be learning valuation in finance. If you have forgotten something regarding yesterday's lecture, now no one of you should forget, which is valuation of anything in finance, whether it is a pin or aeroplane or an economy or a country. It is nothing but present value of future cash flows. If you find out a present value of future cash flows, you get valuation of anything in finance. What is exactly that valuation? Please try to concentrate. I'm not directly starting with the question. I'm taking an example and I'm trying to explain you what type of valuation you get. And believe me, it is helpful in first to last chapter. So this is a basic point. Of course, you have already learned in your intermediate level in capital budgeting, but sometimes the logical idea is not clear. Try to concentrate. I am trying to value a company. Say the company is company X. Is it alright? Who is trying to value it? I am trying to value it. Why? Because I want to purchase this company. So I want to know at what rate I should purchase this company. The first question arises is, sir, what is your required rate of return? I am saying it is 10%. Sir, what is this? What is this actually 10%? 10% is nothing but my cutoff rate. If I get more than 10% rate of return, I do that project. And if I don't get, if I don't get 10% rate of return, if I get less than 10% rate of return, I don't undertake that project. I don't do the business. I don't purchase the business. I don't purchase the asset. That is my nothing but required rate of return. How to find out? Today we are going to learn CAPM model. So we will be covering that point. But my required rate of return is say 10%. Sorry. My first question is how much cash flow this company is generating. I'm not going into detail and directly giving you some figures. At the end of this company is going to run only for 3 years. I know that. How much cash flow it is going to generate in first year? 100 crore. Second year 100 crore. Third year 100 crore. That's correct. This is my cash flows. Is it correct? How to find out value of this X company? Then value of X is nothing but present value of future cash flows. How to find out present value? Into 1 divided by 1.10. I need to find out present value at the rate of 10%. Now I am assuming after yesterday's lecture you are very comfortable in calculating present value, and I am finding out that present value 1 divided by 1.10 is equal to M plus is equal to M plus is equal to M plus. MRC multiplied by 100 is nothing but my answer, that is 248.68. That's correct. This is Please understand, I's valuation. Who is planning to purchase this company? Mr. I. This is I's valuation of X Limited. Whose the discount rate is used? Mr. I's. So this is I's valuation of this X Limited. Sir, this is the rate at which X Limited is ready to sell the company. The answer is no. Sir, is this market price of this company? The answer is no. Sir, is it the valuation of this company done by market? The answer is no. This is I's valuation of X Limited, and try to understand. I is maximum ready to pay. So this is a price which Mr. I is maximum ready to pay. If he pays more than this amount, 248.68, then he will not be earning 10% from his investment. How much minimum he wants? 10%. He will not be earning 10% from his investment. So he is maximum ready to pay 248.68 crore rupees. This is I's maximum price Mr. I is ready to pay. Let me write down in a proper sentence. This is maximum price I is ready to pay. We have learned this first sentence. I's valuation of X Limited. Second, maximum price I is ready to pay for X Limited. And this word you might have heard in amalgamation in n numbers of other chapter. It is also known as intrinsic value of this particular company. My price of this company is 248.68. Is it alright? So all these three wordings you should understand and try to understand now. Market price of this company is 200 crore. Is it alright? I want one person to switch on the mic and tell me, if the market price is 200 crore, what you will do with this company? Whether you will purchase this company or not. Tell me, Sachin.
Yes, sir.
You will be purchasing. Can you tell me the reason?
Because my NPV will be always positive. Because my net cash inflow will be 248.68.
It is not net cash inflow. It is present value of cash inflow.
Value of cash inflow.
Yes.
Yes,
your
present.
NPV will be positive. So you will be undertaking a project.
Yes.
Yeah. What does it mean when you say your NPV will be positive? He is saying my present value of cash inflow is 248. Present value of cash outflow is 200. So positive 48.68 is NPV. When NPV is positive, what does it mean?
I should I should execute the
Agreed. I totally agree. If NPV is positive, you should purchase the company or accept the project. My question is, what does exactly it means when NPV is positive?
It means my required rate of return is whatever I am expecting. It is higher than what I am expecting.
Okay, my actual rate of return is higher than what I am expecting. Your answer is absolutely correct. Your answer is you should purchase this type of company. See, this was a maximum price you were ready to pay, 248.68. It is available at 200 rupees. So you should purchase. Please understand, your NPV will be positive if you will do capital budgeting question. Your answer is purchase because I is getting greater than 10% rate of return. So when NPV is positive, you are getting more than your required rate of return. Alright. Let me take another company and another type of valuation. This was Mr. P who was valuing. His required rate of return was 12%. Alright. What he is planning to purchase? Shares of Reliance. What he is planning to purchase is share of Reliance. Let me take one share of Reliance. Is it all right? Now, it is expected that this share of Reliance he will be keeping for 3 years. He says that he will be keeping for 3 years. The expected dividend after 1 year is 10 rupees. Expected dividend after second year is 10 rupees. Expected dividend after third year is 20 rupees. And whenever he get higher dividend, he plans to sell off the shares. And when he sells the shares, he is expected to get 120 rupees. That's it all. So this will be his cash flow. Sir, why there will be no cash flow in fourth year? Because he is selling. He is expecting that he will be selling after 3 years. Please understand this, all cash flows are not actual cash flows. They are forecasted cash flows. What dividend Reliance is going to give after 1 year, no one can say. Is it all right? So these are all expected cash flows. What is his required rate of return? 12%. So my answer will be into 1 divided by 1.12 raised to 1. This is 1 divided by 1.12 raised to 2. And this is 1 divided by 1.12 raised to 3. I will be finding out all the answers in M plus 10. 1 divided by 1.12 is equal to multiplied by 10 is equal to M plus 1 divided by 1.12 is equal to multiplied by 10 is equal to M plus, and this is 1 divided by 1.12 3 times is equal to multiplied by this is 140 is equal to M plus. MRC is 116. Alright. It is whose valuation? Mr. P's valuation. Of what? Reliance shares. And all of you, I think, will agree that this cannot be market price of the share, because this value is derived by Mr. P's required rate of return. Then what is this value? This is intrinsic value of Reliance shares. This is a maximum price Mr. P is ready to pay for this share. Is it alright? So this is a valuation of Mr. P of which share? Reliance share. Is it alright? What is a market price of this share? Please try to understand. Market price of Reliance is nothing but rupees 200. Alright. One student will help me out. Priyanshi. Priyanshi is present?
Sir, there is network error in
okay,
office.
You can tell me. Sachin, what you will do with this?
Sir, there is network error. Just a minute.
Okay.
Hello.
Yes.
Sir, they should not purchase this.
Alright. Mr. P should not purchase this share. Can you tell me the reason?
Because his total cash inflow, what is expecting, it's less than what he is paying for that.
Exactly, but that should not be compared. This total should not be compared. Is it all right? Let me give you a total which is greater than this. Is it all right? Say market price is 120. Then what?
Then also,
because this total is this is 140, 150 and 160. Total is 160. Huh? But it is nominal cash flow. It is not discounted cash flow.
Nominal, not real. Yeah.
See, the answer is correct. You should not purchase, because Mr. P, if he is purchasing, will be earning less than 12%. Of course, if you apply the concept of capital budgeting, your NPV will be negative, but it is the same thing. NPV is derived from valuation concept. Is it alright? So you should not purchase it. And understand, we'll go one step further. If you are holding the Reliance, Market has overvalued. You will hear this statement in n numbers of times in stock market. Market has overvalued. Something which is overvalued by the market, what you should be doing is selling. Of course, you cannot do in this example because it was a company which you are not owner. But here you may be owner of already some Reliance shares. Then market has overvalued. Your position should be sell. Is it alright? So this is a concept of valuation, and this understand these three questions. Try to understand it perfectly, and whenever you will understand this, you will be having that logical idea of valuation concept. Let us go to Mr. M. Let me even change the color. Mr. M is planning to purchase. First, his required rate of return is 14%. He is planning to purchase a share of Tata. Now, what is his expected cash flow? At the end of first year, he will be getting dividend of 12 rupees. At the end of second year, he is going to get a dividend of 14 rupees. Let me not take 14, 15 rupees. And at the end of third year, he'll be getting dividend of 20 rupees. Start. When he is going to sell the shares, he is planning that he will never be selling the share. So it will be up till infinite. Start. But from fourth year, there will be dividend growth of 10%. So, in fourth year, the dividend will be 22. In fifth year, dividend will be 24.2. And so on with a growth rate of 10%. The dividend will grow at a rate of 10%. Is it alright? I want to find out present value of this. Please understand, these are the questions which is asked probably 3 times in examination with 4 marks. You just need to find out present value. I am teaching you how to find out present value. From when the growth rate is changing? From this year. Here there is a weird growth rate. But now the growth rate is remaining constant, which is nothing but 10%. I need to find out present value. I will be finding out present value, but this portion I will be finding out present value separately. Please understand. Present value, let me change the color. Present value at the rate of 14% of this 3 cash flow. Please understand, I am directly doing it in calculator. 1 divided by 1.14 multiplied by 12 is equal to m plus. First year is completed. 1 divided by 1.14 is equal to multiplied by 15 is equal to m plus. Second year is completed. 1 divided by 1.14 3 times is equal to multiplied by 20 is equal to m plus. All 3 years is completed. MRC is 35.56. But this is a present value of cash flow only of first 3 years. Is it alright? So we need to find out from 4th year. Now from 4th year it is going up to 10 years. No, it is going up till infinite. Then we will be using that infinite cash flow with growth formula. Present value of infinite cash flow with growth is cash flow of a first year divided by rate of interest minus G. But please understand, here I am modifying the formula. Present value is nothing but value at the end of 0 year. This we have learned. Present value is nothing but 0 year. Is it alright? If I want to find out value at the end of 0 year, I need to take the value as on first year. But value as on first year is available or not available? Not available. Which value is available? Value at the end of 4th year is available. So I am changing this formula. Please understand. Instead of 1, I am writing 4, so here instead of 0, it will become 3. Alright. If you start with first year, you get present value, that is 0 year value. If you start with 10th year, you will be getting 9th year value. If you start with 15th year, you will be getting 14th year value. I am starting with 4th year, I will be getting value as on 3rd year. So value, what will be value as on 3rd year? This is 22 divided by rate of interest is 14% and growth rate is 10%. So this is 22 divided by 4%. The answer will be 22 divided by 4%. It is 550. But please understand, this is value at the end of 3rd year. This is value at the end of 0 year. Is it alright? This is value at the end of 0 year. Is it alright? I need to convert this into 0 year. What I'll do, I'll again discount it by 3 years. If I again discount it by 3 years, this value as on 3rd year will be converted into value as on 0 year. Now this is simple to calculate. 1